Hello, everyone. Today on the final bar, I'm talking to Samantha LaDuc from LaDuc Capital. We'll get some big picture analysis from her, how to navigate this market today. Choppy day for the major averages. The S&P basically unchanged from yesterday. This is after a big distribution day yesterday. We didn't have a live show yesterday, so I want to debrief a little bit off of that short-term distribution, how the short-term weakness relates to the long-term weakness that we've been seeing for stocks. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the power of technical analysis, using the technical toolkit built on data visualization, investor psychology, and market dynamics to help us better understand what's happening in the world around us as investors. Now, today, relatively choppy, relatively quiet day among a lot of noise. So we'll take it. We'll take the brief break after yesterday's, severe downturn. Severe is maybe a heavy word for it, but you certainly saw some signs of distribution yesterday. You know, as we talked about many times on the show, I think of the market in multiple timeframes. You have the short-term tactical timeframe, the medium-term timeframe, looking a month or two out, then you have the longer-term timeframe, and you really need to understand the relationship between all of those. We've seen short-term strength, which is now potentially showing short-term weakness. We'll talk about one of the key groups, energy, which I think is so important to watch, and which names and which levels we should be keyed in on. We have a lot of great content on this show. I'm excited to talk to Samantha LaDuc here in a few moments. She's one of my favorites in terms of macro strategy, big picture analysis. Tomorrow on Thursday the 30th, we have Sean McLaughlin, who's the chief options strategist at All-Star Charts. Next week, we'll be taking Monday off for the 4th of July holiday. Wish you all a very happy 4th and hope you're able to celebrate safely with those around you. And we'll be back live on Tuesday. On the 5th next week, we have Jesse Felder, founder of the Felder Report. And then on the 7th, we have Todd Sohn from Strategas Research Partners. Let's continue on today's show. Let's talk about the markets. Let's do our market recap. So in terms of the major averages, choppy and directionally not really going anywhere. This is one of those sideways days, really meaning market equilibrium. Buyers and sellers are in agreement. The S&P is worth around 3820 points as of the open, and really as of the close. That's about where we netted off. So it's an unchanged day overall. Dow was up a little bit. The S&P 100 up a bit, but overall it was essentially flat. The VIX pulling back a little bit, by the way, remaining below 30. It's down to 28, but still fairly elevated relative to averages over the last couple of years for sure. Elsewhere, in terms of interest rates, we have yields coming off a bit. 10-year yields still around 309. Long bond yields a little above there, around 321. So coming off a bit, but still fairly high relative to where we've been historically. My guest today, Samantha LaDuc, has some great charts just showing where interest rates have come from and some thoughts about where we might be headed next. The dollar index up again today. The UUP, which is our proxy for the dollar index. It's a bullish dollar ETF, up about 0.6% today. Commodities coming off a bit with the DBC down almost 2%. Gold and silver essentially flat to down just a little bit, but oil prices down, energy prices down. So the energy sector was certainly a downside outlier just looking at today's trading. Cryptocurrencies overall, I would argue, showing weakness versus strength. With Bitcoin and Ether, you're seeing a bit of a bounce here just before going live, but overall, these are fairly heavy charts when you look at where they've come from and the prospects of where they may be going to. Big round numbers tend to mean a lot for things like Bitcoin. We keep chopping around that 20,000 level, which is an absolutely important level I would be paying attention to. I have a chart a little later about Bitcoin that I'll share with you with a take on where we may be headed next. Looking at a daily chart of the S&P 500 here to continue our market recap. You know, I'm struck when I was reviewing the charts this morning, part of my morning coffee routine. Two things. Number one, my market trend models remain bearish for the long term and the medium term. The short-term model was bullish as of Friday's close, but if the week ended today, it would turn back to the negative side. So overall, certainly the downtrend confirmed on most timeframes by my analysis. And I'm struck on the daily chart of the S&P, just this fairly consistent pattern of lower highs and lower lows. If you look, pretty much every month, the S&P has made a new closing low for the year. That tells you something, right? I mean, when that stops happening, we can start talking about the excitement building for a potential for a further upside from there. But as long as the S&P keeps making a new low every month, it certainly feels like the market's heavier rather than lighter. But what also strikes me is the momentum characteristics really of the S&P. Except for a brief period in late March. Other than that, all of 2021 and 2022, and even going back to November of last year, we've remained the RSI below 60. And most of the time, it's been the RSI below 50. And that basically tells you the entire momentum is sort of down a little bit, right? It's showing you strength on down days and limited strength on up days. And that is overall what a bear market sort of looks like and sort of feels like. Again, when I'm thinking of a bottoming checklist, what would tell me to start anticipating some sort of bottoming patterns? I would be looking for the market to stop going lower. Number one, the most bullish thing the market can do is go up. That's what legendary technical analyst Joe Montgomery used to say. But also the fact that you would see some improvement in momentum, right? The RSI remains below 50 on rallies, on these bear market rallies. It's not really gotten much above 60, and that's really what a bear market tends to feel like. When that's broken, when that changes, then you can start getting interested in what may be next. We'll talk a little bit about the sector returns here in a minute, but I was running some charts for my premium members at Market Misbehavior earlier today. And we're talking about communication services. I just want to highlight one of the stocks we were looking at, Live Nation, LYV. If you were trying to find a really good chart in communication services, I will be honest with you, it's not easy because they go from really bad to pretty bad. And the most constructive would be something like Lumen Technologies. And the only real redeeming quality of that chart is it's not going down while everything else is. So that doesn't make me feel great about the sector. I'd much rather be in things which are improving in terms of price characteristics. But in some cases, in some environments, not going down is pretty decent. And it's an opportunity to outperform just being in a passive asset. However, Live Nation is one of the series of names within communication services showing what's called a bullish momentum divergence. So if you look at Live Nation May into June, you have a lower low, a lower closing low, but you have higher momentum, right? So the low in May, the RSI becomes oversold. We have the new low in about a week ago in mid-June, but the RSI is now oversold. That's what's called a bullish momentum divergence with lower prices and higher momentum. Now, obviously, one of two things can happen from here. Either we rally from this moment that ends up being a beautiful early warning of a rallying stock, or we fail to hold it. So let's talk about what that would look like in either scenario. The bullish scenario, if this bullish divergence sort of plays out, and the way I tend to think of divergences, this is probably not where I would initiate some sort of position. This is what would put it on a list that I would then monitor, and I would look for an improvement, look for some sort of validation. Now, validation could come in the forms of just starting to trend higher, breaking above the 50-day moving average, which would at least indicate some, consistent buying power that's able to push prices higher. Ideally, we get above the most recent swing high, which would be around 97 or so for Live Nation. So there's quite a bit of ground to be made up before that would really confirm a break to the upside. So that would be the bullish scenario and what I would look for. The bearish scenario, though, is basically the divergence does not play out. And this divergence no longer becomes a divergence because you make a new swing low and the momentum starts to increase to the downside. So it's an interesting chart right now because I think the market is at a key moment here. You've seen a bounce in some of the names like Live Nation. You've seen bounces in some of the energy stocks now rolling over a bit. Are those stocks able to hold support? Does Live Nation actually follow through with a bullish divergence and start to rotate higher? Those things would indicate an influx of buyers, some people buying on weakness enough that it's able to propel the major averages higher. However, though, I think these charts also have included some pretty clear signs that things are breaking down. Charts like Diamondback Energy fail to hold support. Charts like not Live Nation don't follow through on the bullish divergence. And it indicates a lot further to be had in terms of price and or time for this bear market phase. So Live Nation is a good chart to pay attention to here, I would argue. Finishing off our market recap here, very briefly before the break, I would look at the sector summary. Healthcare number one I'm remembering my conversation with Mary Ellen McGonigal. I think that was last week, maybe, where she shared a couple stocks and groups within the healthcare sector, talked about that emergence of that area. It's a great point because you're seeing some improvement in some of those charts. A day like today, pretty impressive with healthcare up while the market is sort of flat. After that, it's consumer staples, which is a fairly defensive area of the market, number one and number two. On the downside, energy. And this is a concern because if you've been in the energy trade, you've had overall probably a really decent 2022, although it's felt a lot less decent in the last month because you went from being up 70 some percent to only up 30%. Now, you're still up 30%, so that's good year to date. However, it's starting to feel like that luster is off of some of those stocks. A day like today, where you continue to push down, is concerning. What again, going to a chart like DVN or FANG or any of these sort of strong, high performing energy stocks over the last year, they've all pulled back. Many of them have broken their 50-day moving average. All of that has happened. So the question now is what's next? They're all testing key support levels. FANG is testing its 200-day. DVN is testing previous support just above the 200-day. My question for these names, are they able to hold that key support level? A lot of damage has been done. Have they broken down? The RSI has gone now into a more of a bearish range. Do they follow through? Are they able to hold support or not? Through the remainder of this week, we might get an answer to that question. Let's take a quick commercial break. We'll be back with Samantha LaDuc. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close for our show. As a reminder, all of our previous episodes are stored at StockChartsTV.com, but this show is fueled by some fantastic guest experts, but also your questions. We'll do a mailbag segment at the end of this week on Friday's show, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. Fantastic, knowledgeable experts like Samantha LaDuc, Mary Ellen McGonigal, Larry Williams, Martin Pring, many, many more, all on demand at StockChartsTV.com, or on your mobile device, just search for Stock Charts TV on demand. I want to welcome on today's guest. She's a frequent guest on our show, and it's a pleasure to have you back. Samantha LaDuc, founder of LaDuc Capital. Samantha, welcome back.
Thank you so much, David. Happy summer.
You as well. So we'll start talking about the interest rate environment. Obviously, this has been a huge theme in 2022. The Fed completely changing perspective and their policies. It's causing changes in rates. Give us a sense of how you're thinking of this space here.
Oh, I'm still an inflationista. As I mentioned, kind of quarterly, we go over this. Yeah. Since my things over paper mantra from summer of 2020, I still see yields moving higher. I still see oil as bullish, despite, yes, your high point of, highlighting the fact that it has pulled down in the past month or so. I think it'll get defended and pick back up in the new quarter. And I'm very bullish the dollar. So themes that have been very consistent that we've reviewed pretty much every quarter. I'm still bullish the dollar, still bullish yields, still bullish oil.
It's amazing how that trend has just worked. I feel like in a lot of ways, my conversations with you, those conversations alone hopefully would have put investors in the right mindset to be prepared for 2022. What do you see? We're looking at the 5-year yield here. Like, where do we go? Because we've already made new highs now relative to the last couple of years, right?
We have, and I know that there's a lot right now that is expected that the Fed is going to get, very, very aggressively, on the path of inflation tamponing. But I think we're between a rock and a hard place. So if they're not hawkish enough, if there's any dovish or pivot, then oil is going to take off higher and pull yields higher, and vice versa. If they're just it doesn't matter what they do. That inverse relationship between the market equities and the rate of change, strength, and yields, and pulling up energy, which is very, very depressing to equities, especially tech. They're between a rock and a hard place. So I always go back to my rate of change that StockCharts obviously kind of shows so well in the 5-year and the 20-year yield charts that I have shown, which you can see with the yellow highlighting down at the bottom. It's extremely bid, which means this is a ongoing momentum thrust. There is not a weakness in the strength of rate of change. And in my experience, this is not like a parabola that corrects. In other words, the yields come crashing down. It's basically a multi-year advance in rate of change. These are momentum thrusts that are very bullish long-term. And therefore, I'm very bullish the energy patch.
It's interesting. The chart behind me on my wall, one of them is a long-term chart of interest rates, and it basically reminds you of how long some of these rate movements can happen. They can last a lot longer than you'd expect. I do want to just, how do we relate that idea of higher rates and inflationary pressures to equities? What are you seeing in that space now?
Well, first, I think that inflation peaking is just a misnomer. I think we're going to have rolling peaks of inflation, very much like the 70s. I think monetary policy from 1974 is being pulled out as the playbook. And I think we're going to have rolling peaks of inflation in the same way that we're going to have rolling bottoms in equities. We're still going down. I think we climbed up the mountain and now, plateaued for 2021 while lots of breadth destruction under the surface in mid-cap tech and SPACs and all the stuff that we know about already, China, et cetera. And now we're really very firmly going down the mountain on the other side for 2022. And that makes sense. It ties with the regime of quantitative easing, right? And now quantitative tightening. So another kind of emphasis is pulling back in time, looking at NYSE, which has a large number of constituents, like 1700, 1692, whatever. And you can also see in MACD, which is an intermarket tell, that we have lots of levels still on the downside, just from a pattern recognition standpoint, or from we haven't bottomed yet, and we have still lots of room to bottom. So in the same way that I see rolling peaks of inflation, I see rolling bottoms. We're going to keep going down.
You invoked the 70s. That is harsh, Samantha, but well-founded. There's a decent backing to that statement. We only have a minute left, but I did want to get your last shot. You mentioned breadth that was starting to decline. Here we're looking at the advanced decline line on the bottom, right?
Correct. And this to me, and I have done it for NASDAQ, which is at a scary point of basically cliff diving. This is NYSE again, the NYA advanced decline, and it is very clearly showing in November. We had a lovely, breakout, but it was a fake breakout, fast failure. And every single, you can kind of see the red circles, every bounce has been trounced. So these are bear market rallies. I feel very firmly about that. I follow volume and breadth very closely in my intermarket analysis for clients. And I do not see a capitulatory low. We've gotten close, but it could be very much like in the 2014 to 2016, we had an oil recession. Market went sideways for the most part, while there was a complete bludgeoning of the energy space. We're getting that in the tech sectors now, and I think it's going to go on for a while, another year or two.
So the rallies are bear market rallies, or wishful thinking rallies, as we might call them. Samantha, listen, this is a fantastic take. I love the way you laid out the case for concerns with inflation, higher rates, their impact on stocks. Great to see you. Stay safe there, and we'll talk to you again soon.
Happy summer.
That's Samantha LaDuc. Samantha's the founder of LaDuc Trading. I love how she used those 4 charts to really tell the story, looking at long bond yields, 5-year yields, the S&P, along with, looking at trend essentially with the MACD, and then looking at breadth, a great way of connecting intermarket analysis. And as you all hopefully know very well, John Murphy literally wrote the book on intermarket analysis. Our chief technical strategist has done such a great job of publicizing and proliferating that concept of thinking about the relationship between these different markets. So a lot of great articles on our chart school to help inform you of how to use those techniques, and a beautifully designed thesis there from Samantha LaDuc. Let's continue on today's show. Banking on breadth is our next segment. What we like to do to check in every once in a while on breadth indicators. I thought Samantha did a great job of laying out the big picture on breadth. My main breadth chart looks at the cumulative advanced decline lines on 4 different cap tiers. At times, this will tell you different things, because you will find that large cap breadth may be different than small cap breadth. That can tell you a little bit about risk appetite and, whether people are, taking risks or, taking aggressive bets or being more conservative. At this point, though, they are all colored red, and that is done for a reason. All four of these, by my read, are still very much in a decline. Making new lows. The advanced decline line for the New York Stock Exchange is at the top, made a new low earlier this month in June for the year, and has made a new low every month in 2022. But you find for large cap breadth, new low in June, same for mid caps, same for small caps. So get excited, get interested in stocks when these advanced decline lines stop making new lows. The fact that the cumulative advanced decline lines still make new lows is telling you that overall stocks are in a downtrend, not just the major averages, not just the FANG stocks, but on average. This is looking more at the average performance of all the constituents that make up those different cap tiers, the S&P large cap, mid cap, small cap indexes. So I would agree with Samantha's take that the breadth overall is still fairly negative. And while you can talk about that on the big picture, which is what the cumulative advanced decline line, so you can also look at it on individual days, and you can recognize when there are influxes of bullish sentiment or bearish sentiment by where these days play out. We've had very few 90% up days or 90% down days using this particular metric. This is looking at all the listings on the New York Stock Exchange, how many are up versus the total listings. There are a couple different ways that people like to quote 90% up days and down days. This is the way that I've done it for a long period of time. We've only had one 90% down day and no 90% up days in the last year. And that was just a couple of weeks ago. That was on that first sort of initial, sell-off. We then had that third day lower, this big week of downtrend a couple of weeks ago. And that last one was where we had a 90% down day. Now, what happens when you get to the end of a move is a lot of times you'll have a capitulation where it feels like sort of everything's down. What's not happened, though, is that you've seen enough of an accumulation that tells you that the market has indeed capitulated. When I look at the trend in breadth, when I look at the trend in volume, I'm not seeing the signs of capitulation, meaning the end of any particular move just yet. We can also look at stocks relative to key moving averages. This is a chart we've referred to regularly on the show, and just to review. Still very, very, very negative, right? If we look, 23% of the S&P members as of today's close are above their 200-day moving average. That's 3 out of 4, obviously below their 200-day moving average. In terms of relative to the 50 days, about 15% of the S&P members that are above their 50-day moving average, which means 85% of the S&P members are currently below their 50-day moving average. I have these horizontal lines right at 50% because that's my quick read. Are we above or below that sort of basic measure of breadth strength or breadth weakness? We've been below 50% since mid-April, which tells me overall, even though we've had these rallies, these bear market rallies or wishful thinking rallies, as I called them a little earlier, the fact that we haven't had enough of a materialization of an uptrend, enough stocks breaking above their 50-day moving average, it tells you there's not a lot of staying power to that uptrend. That's why in late March, this started to seem potentially constructive. And I will admit, I was certainly talking about the possibility of retesting all-time highs, if not going higher, going up to 5,000 in the near term, because we'd closed above the February highs and this momentum or this breadth indicator had gotten above 50%. Quickly reverted back to the downside, right? Not a follow through. We had one day of closing above that 4,600 level, and that was it. We didn't get enough of a sustained advance to push on to all-time highs. And from there, the indicator quickly went back below the 50% level. So in these rallies, the way that I sort of stay calm and collected and reflecting on the trend, besides looking at a market trend model that I've used for years, it's looking at charts like this, which remind you that the breadth conditions are still fairly negative. There's not a lot to be excited about just yet. The bullish percent index for the S&P 500 has gone back up above 30%, remains well below 50%. And so overall, this is still telling you that most stocks are in a bearish point and figure pattern. The extreme negativity that we saw in mid-June has now been alleviated. What I would be looking for, which would be a cause for an indication of the next leg down, this gets below 30% again. You can see when that goes below 30%, that's the signs of the big pushes down to watch out for. And so that's what I look for here. Getting back above 50%, by the way, would tell us we have more of a bear market rally to deal with, and to potentially look at key resistance levels to see if we're able to eclipse those or not. Just two other breadth indicators I'll highlight very quickly. The McClellan oscillator has gone back above zero. And if you look back through the course of 2021, it's really an oscillator, as evidenced by the name, right? The McClellan oscillator is more like an RSI for the market, if that makes sense. It's smoothing out the advanced decline data to show you overall, are we seeing, strength or weakness during a brief look back period. And on these bear market rallies, you'll see the McClellan oscillator get above zero, often as a leading indicator, often happens before that rally materializes. So the fact that we got above zero there about a week ago tells you there's some strength. Getting back below zero would confirm that the bear market rally has completed, and now we're in the next leg lower, which is why that might be an interesting chart to watch there. I did want to mention Marty Zweig's indicator, we'll call the Zweig breadth thrust. Now, this is one, if you Google it or look at our chart school pages, there are a number of different ways that people have tried to apply this methodology, but it's essentially looking for when stocks are beaten down, when the breadth is very weak. And that happens when this green line gets below 0.4. And that is essentially a moving average of the advancers in the market as a percentage of the total listings on the New York Stock Exchange. So it is initiated when it gets below 0.4. It needs to get above 0.62 within 10 trading days to register a buy signal. And the mentality or the idea behind this indicator is when breadth is really beaten down and then it reverses to very strong breadth very quickly. That often indicates that capitulation that I mentioned. So it starts with everything getting bombed out, but then enough buyers come in to push it to more of a bullish reading in the very near future. That has not happened, and it looks highly unlikely unless we have a huge rally through the remainder of this week. Most likely, the Zweig breadth thrust is not confirmed and not completed. And again, that's yet another signal that the downtrend overall for this market is not quite done. We need to wrap the show. We'll go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment, starting with chart number 1. Our first chart here is looking at breadth in a little different angle. Our segment banking on breadth, we like to dig into some of the breadth indicators that are most important to us. I thought my guest today, Samantha LaDuc, made such a great point about the deterioration in breadth. That was the last chart that she shared with us. This is a chart that I think tells that story very well. Every month in 2022, the S&P has made a new closing low. Every month in 2022, even going back to November of last year, the advanced decline line in the New York Stock Exchange, looking at common stocks only, has made a new low as well. When that stops happening, when we have a month, July or August or September, whenever it is, when the S&P does not make a new closing low, when the advanced decline line does not make a new low, then you will hear me talk a lot more constructively about the prospects for the S&P going materially higher. At this point, though, I'm seeing plenty of weakness and a trend that continues to be downwards. Chart number 2 in our 3 in 3 is the semiconductor relative performance. This is a simple ratio of the SMH, which is a semiconductor ETF, versus the SPY. So if this is going up, semiconductors are outperforming. If this is going down, semiconductors are underperforming. I wanted to highlight this week the relative strength in semiconductors making a new low. Now, semiconductors is sort of a bellwether group that I tend to follow in general. When this ratio is going up, semiconductors are doing well. They're such a staple of the economy. They're such a central part of the functioning of what I would call the new economy, that semiconductors doing well is usually a good sign of economic conditions. Semiconductors struggling tells you economic conditions are not quite as good, or in terms of our expectations for economic growth going forward. Semiconductor ETF making a new low is a concern because it had been rallying in May, actually did not make a new low in May. And this was actually one of the broad indicators that I have followed in 2022 to keep me on the bearish side, to keep me, sort of with minimal expectations of market upside. That bounce in May caused me to question that a little bit. We're now making a new low yet again. A lot of weakness in the technology sector, to be sure. Our final chart in the 3 in 3 is Bitcoin. When I'm looking at Bitcoin here, and I'm simply looking at the last 2 years, and I'm highlighted with these blue horizontal lines, big round numbers like 60,000, 50,000, 40, 30, 20, and 10,000. If you look at what's happened in 2022, we sold off to 50,000 and sort of went sideways for a bit. We came down to 40,000. We stalled out and went sideways for a bit. We then went down to 30,000 sideways, now 20,000 sideways. The problem is if we break this, what's next? And I would argue we're going back toward the lows. I wouldn't think that 10,000 is an unrealistic downside expectation. Folks, that's our show for today. Special thank you to Samantha LaDuc from LaDuc Training joining us on the show today. All of our previous episodes at StockChartsTV.com. For StockCharts, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.